Wayfair is up last year around 90%. So both these two aren't the only ones. Last year we had Hasbro and Etsy announcing layoffs as well, so it just really speaks to the competitive landscape and, of course, companies really trying to keep their margins up. Alex.
Yes, such a good point. The margin maintenance. All right, Isabel, thanks a lot. So Richard Bernstein's Dan Suzuki is optimistic for the year ahead. He writes this: when coupled with the prevailing bifurcation of sentiment and record market concentration, the current juncture may offer investors a once-in-a-generation opportunity to rebalance portfolios. And Dan joins us now. Dan, I'm so thrilled to talk to you. It has been so long since you and I have talked. It's good to see you. What's this once-in-a-generation moment that you're looking at here?
Yeah, Alex, it's great to see you. You need to fill in for John more often. Yeah, so I think that this is one of those once-in-a-generation opportunities. And, we put out a report last week, and I basically looked at the best performing trades of the last 50 or 60 years. And, the one thing that they have in common is, they start out with huge skepticism and scarcity of capital, but by the end, the dominant fundamentals get so exciting that they become, the only investment worth owning at the detriment of everything else. Mm-hmm. And so once you reach that point at which that's the only thing investors want to know, they'll pay any price to own it, that sets up for a huge underperformance and a rotation into a leadership elsewhere in other markets. So, you go back to as early as the 50s and 60s, you had the U.S. Nifty 50, these huge blue chip large cap stocks, which dominated their industries, had the best cash flows. That was the only thing you needed to own. And then, the multiples got crazy, and it set up for 2 decades of underperformance for the U.S. Then you obviously had the tech and telecom stocks in the 90s. That's all you had to own with the internet wave. That didn't work out turned into the lost decade in the U.S. And then here, the last 15 years, we've had the rise of U.S. large cap growth, mm-hmm. and culminating with the rise of the Magnificent Seven. Again, these are the only stocks worth owning. That's usually a warning sign that the opportunities are probably elsewhere.
So I hear you, Dan. You could have made this argument, though, last July and also last December. So why is it the argument now with big tech?
Yeah, I think you can look at it from a couple different ways, Alex. I mean, one, from that long-term perspective, thinking about what the biggest trades are going to be over the next 10 years and what the worst trades will be. I mean, you've never before seen, relative to all those other, concentrated stories I've mentioned, this one is actually more extreme from a concentration perspective and evaluation perspective. The U.S. has gone from 40% of the global stock market to something like 63, 64%. The Mag 7 has gone from 7 to 30% of the U.S. And then on top of that, the U.S., trades at a record, premium to the rest of the world, 60% more expensive than everywhere else in the world. So there's that long-term story. But I think the question you're really asking, Alex, is, what's changed recently? And mm-hmm. I think here it's really about the cyclical story. And I think that earnings, a lot of people would disagree, is going to continue to accelerate, as this recovery matures, but it's not going to be driven, by these, big growth sectors. Their earnings have been strong, mm-hmm. but if you look at the earnings estimates, they're actually set to decelerate in the coming quarters. So what do you want to own? The sectors that are going to drive that acceleration. I think that's going to be small caps. I think that's going to be industrials, energy, emerging markets even. I just don't think it's going to be these names, and that's going to lead to some potential disappointments.
So you make an interesting point about earnings growth for those cyclicals. On the flip side, though, that kind of earnings growth doesn't square with 7 rate cuts priced in from the Fed. So does that mean that you expect the Fed to not cut as much? And then does that then have a knock-on effect into how those cyclicals perform?
Yeah, actually, I don't know that the Fed is going to be a huge swing factor. I mean, obviously, it's what everybody wants to talk about. I don't think that the Fed's going to cut 5, 6, or 7 times this year. I don't think they're going to be anywhere close to that. I just don't know that that's going to have a big, be a huge swing factor for markets. Ultimately, I think what's going to drive markets is going to be growth. And I think in the near term, growth is going to be better than expected. But as you get out to the second half of the year, I think the visibility is quite low. So you need to be on your toes and look out for those signals that perhaps at some point growth is going to be rolling over. But to be clear, we're just not seeing any of those signs right now.
So then if you take a look at the rotation that you're expecting then from big tech to the cyclicals, what does that rotation wind up actually looking like?
Well, I think this is actually a pretty classic rotation, Alex. I mean, there's nothing necessarily that unique about this particular earnings recovery. If you look throughout every earnings recovery, what happens is, people when earnings are terrible, are piling into the small and shrinking group of companies. They're able to continue to put up really strong growth. That continues to be the case, and why part of the reason why market leadership has been very narrow. But as growth broadens out and more companies can put up really strong earnings, there's a natural, the market becomes comparison shoppers. So why pay 30 times for the same growth that you can get for companies that trade at single-digit multiples? That's the sort of thinking that happens almost in every single earnings recovery.
So for the NASDAQ, though, for example, do we see a bear market in this sort of scenario that you're looking at, or it's not that dramatic, it's just more about the cyclicals?
Yeah, I think eventually you are going to see a bear market. I've gone on so far as to say I think that this is a bubble, and I don't use that term lightly, so eventually that suggests that there's going to be a reckoning. I don't necessarily think that has to happen in the near term. I think initially, really the story could be underperformance as investors realize that there's other really attractive growth stories out there. I think maybe the next shoe to drop that really causes that potential downside for the sector is when things get really bad. Now, that could be 6 months from now, and that could be 2 years from now, but when growth really starts to roll over, I think people will be surprised, as they always seem to be, at how cyclical these companies' earnings are. Remember that if you go back a year ago, these companies that everybody have the best growth now, they were the ones leading us into the profits recession that we saw. So they are clearly cyclical. People just forget about that.
Totally fair. All right, Dan, you're going to stick with me. Dan Suzuki staying. Coming up, all eyes on earnings next week.
If you look at consensus estimates for this year, tech earnings are supposed to be up in double digits. Now, maybe it's not going to be quite as high as that for the year, but I think double-digit earnings growth out of, say, a broad NASDAQ 100 index is I think, what investors essentially are counting on.
That conversation coming up next. As you look at a Friday, we're seeing a little bit of upside in stocks. This is Bloomberg.
If you look at consensus estimates for this year, tech earnings are supposed to be up in double digits. Now, maybe it's not going to be quite as high as that for the year, but I think double-digit earnings growth out of, say, a broad NASDAQ 100 index is I think, what investors essentially are counting on. And so far, tech stocks have been able to deliver. So as long as we're in that range, it's better than about any other index can provide, and that's certainly why the enthusiasm is there, the flows are there, and also the valuations.
Earnings season kicking into high gear next week. Major airlines, a handful of consumer staples on deck. Abigail Doolittle is back with us for more. Abby?
Well, Alex, it's really pretty amazing because over the next 3 weeks, we will have nearly $30 trillion worth of market cap of companies reporting. Now, the bulk of that, of course, is big tech, and that's where a lot of the focus is, given their huge rally supporting these markets over the last year. But as you mentioned, lots of other companies reporting, including United Airlines. A big question there will be, will they follow in Delta's path and give a more conservative profit view than what will be expected? There's a chance that could happen. Higher wages could weigh on United's fourth quarter earnings as fares apparently are weakening and pushing their operating profit and margins lower. So stay tuned. D.R. Horton, the home builder, now their results will be a balance of looking forward and backward. Net new home orders may climb 37% in the first quarter versus the last year, but also it's going to include the look back in terms of the 8% mortgage. What influence will that have? Order results typically a leading, but because of that factor, we'll be looking backwards a little bit. Gross margins could be crimped by buyer incentives, but some analysts are saying December that the color there could be good. And then finally, we'll also have some of the consumer companies reporting, such as Clorox and P&G. P&G will see broad-based organic growth sales, apparently, according to analysts, across categories and regions. Will that happen again? An unchanged guide there would be very good. And then 3M, the conglomerate, they're looking to see their sales declines basically level out, plus potentially a positive update around litigation and more information on the earplug settlement. Stay tuned, Alex.
All right, Abby, thanks a lot. Hey, just to update everybody, we're seeing the S&P rolling over a bit, right around the lows of the session. Still in positive territory. The NASDAQ still at a record, but we are kind of rolling over here, and the VIX popping a little higher. Again, still negative, quote unquote, but we are seeing a little bit of pop. So just watch this as we head throughout the trading day. Let's turn to tech now. You got Netflix, Tesla, Intel, and more set to report next week. Ed Ludlow is back with us. Ed?
Yeah, good morning, Alex. I guess that Abby gave us a good setup, but look at the gains of the NASDAQ 100 and S&P 500 in 2023 and the outsized contribution to those gains, both from a stock index performance, but also a profit contribution from the Magnificent Seven. Luckily, we kind of start earnings in earnest next week, slowly. And if you're to draw some commonality, look particularly to the chip makers, Texas Instruments earlier in the week, Intel on Thursday. After we had that kind of outlook from TSMC 24 hours ago, what we will look is to the chip makers and ask, is there recovery in end markets, broad end markets, right from sort of more analog semiconductors that go into cars and consumer electronics right through to PC and data center. Tesla will be the big one, and the narrative around Tesla is that they have this target of 50% annual growth, but we're in a 2% environment. You saw the Ford news that we discussed earlier today, that growth in EV demand in 2024 will be less than expected. Does Tesla maintain that 50% annual growth in that environment? And then beyond that, Netflix, I think there's a lot of confidence about Netflix that they finished 2023 strong. We have the writers and actors strike behind us. What does the content slate look like? But again, this kind of existential question of how do you be profitable in streaming will continue to be something that the street discusses in 2024. Then it's AI everything. And go back to December, our colleagues at the equities team in their Tech Watch column set it very clearly. The now expectation from the street is, show us that AI is making a contribution to the bottom line. That will be the theme this earnings season.
Yep, straight up. All right, Ed, thanks a lot. Really appreciate it. So Dan Suzuki of Richard Bernstein still with us. So Dan, that kind of puts all stories together. Is it margin management? Like, is that the thing that's going to be the earnings season all about?
Yeah, I think it's really a tug of war right now, Alex. I mean, on one hand, you got margin management because you got pressures from labor costs, input costs, and interest costs. But then on the other hand, I think what you have is a lot of people are forgetting about is operating leverage. I mean, I think if you look at the last couple of quarters, what not a lot of people are talking about is you're finally starting to see top line sales growth accelerate. And that's what you really need to see. In every earnings recovery, it starts with margin expansion through through cost cutting, and then you have to pass the baton to operating leverage. I think that's what you're going to start to see. That's what's going to drive this next leg of earnings growth here, and that's why you want to own those companies that are going to see that operating leverage kick in.
Where do we see, though, what about consumer demand in terms of those kind of stocks? Like, we're all waiting for that to sort of fall out of bed. We saw Wayfair and Macy's doing some layoffs. What do you think we see there?
Yeah, I think that the market tends to swing in these huge, has these huge pendulum swings in terms of the narrative, and it's usually not that extreme. So it's either, the consumer is accelerating, booming, and going to the moon, or it's falling off a cliff. And I think it's much less exciting of a story. My personal opinion is if you look at the drivers of consumption like labor and wages and overall economic growth, it's going to be gradually slowing here. And so I think it's normal to expect that to gradually slow, but clearly not fall off a cliff. I mean, you're seeing retail sales, as everybody cited, really strong. Their balance sheets are really strong. Interest rates are coming down. So there's no reason to think that they're going to collapse immediately. So I think that area of the market should be resilient. But we are, in my view, late in the economic cycle. I prefer late cycle plays, less, focus on the consumer.
Yeah, I'm not spending, Dan. I don't know if you know this, but I'm on a budget. It's a big deal. I'm definitely not spending, I promise. All right, Dan, thanks a lot. Dan Suzuki joining us. Really good to see you. Let's get some sector price action this morning and get to Bloomberg's Abigail Doolittle. Abby?
Well, after the last month, Alex, I'm not spending either. As for the sectors on the day, we have a small decline right now, gain for the S&P 500, but it is not a well-supported gain from a composition standpoint. Just 4 sectors are higher: communication services, tech, financials, and real estate to the downside, all the other sectors. So broad-based selling from a composition standpoint, but you have 2 of those sectors with big heavyweight weightings to the S&P 500, and the index is higher. Over the last 5 days, it's a similar story. We have just 2 sectors higher, tech and communication services, but big gains there. And for that reason, the S&P 500, I believe, is heading, to just a small gain. And it's interesting also to the downside, real estate and utilities, those are the worst 2 sectors. Those are defensive sectors, so in some ways you could say that's risk on. But the fact that you have 9 sectors down, 2 up, I don't know, Alex. Not great.
Yeah, it's looking a little messy there. All right, Abigail, thank you very much. Coming up, the market moving events you need to be watching. That's next in our trading diary. This is Bloomberg. bit, but the superlatives are still count. The Nasdaq 100 at a record intraday and record close. The S&P at a record close right now, but intraday we're still about 10 points off. So now it's time for your trading diary. What you need to know about the day ahead and what we're watching throughout the rest of the week. UMich, consumer sentiment, existing home sales coming at the top of the hour. Then check out Tuesday. We're going to get the BOJ rate decision plus Netflix reporting earnings, and tech earnings continue Wednesday. Tesla, IBM Thursday, ECB rate decision. We'll also get U.S. GDP, and American Express reports earnings on Friday. We're just getting warmed up. This was the countdown to the open. Happy snowy Friday, everybody. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading, Friday, January 19th. Here are the top market stories that we're following for you at this hour. What's old is new again. Nasdaq 100 hits a record with chips really leading the way as AI tech trade of 2023 just takes over. And overpricing cuts. Mohamed Al-Arian says markets are overdoing the rate cut scenario. We're going to get the take from Ralph Schlosstein, Evercore Chairman Emeritus. And retail job cuts. Macy's and Wayfair announcing layoffs. We are going to get the latest read on how people are feeling with Joanne Shu, University of Michigan Survey of Consumers Directors, as the data drops right now. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. All right, Guy, this is one of my favorite surveys. What do we got?
It is, for the last time ever, we'll do this together. We'll work our way through the data, which I have to say, Alex, is a bit hot and a bit cold. So let's talk about the headline number. Headline number comes through at 78.8. Yep, 78.8. That's up from 69.7. That's quite the turnaround, isn't it? In fact, all of the expectations, current conditions numbers look really hot. What is cold, though, is the one-year inflation number, which drops to 2.9, which is why the yield has softened a little bit, I think. The housing number comes in a little soft as well. Existing home sales come in 3.78 million. But I think the UMich data is fascinating. Sentiment improves dramatically. Inflation doesn't. Maybe there's a connection there.
Well, let's have someone else before we get to Joanne Shu. Michael McKee. He's here to break down the numbers. We made him run, so let's go for it. Mike, what do you make of this?
Well, it's kind of hard to say that it's going to change anybody's minds, because at this point we know that the retail sales numbers came in reasonably good. And so the Michigan numbers aren't going to change people's views of whether or not the economy is going to continue getting better. As Guy says, the idea of the inflation numbers may be a little bit of an issue for the Fed, but probably not. They've looked beyond this, and they think that it goes up and down a little bit. And certainly, since we're seeing gas prices continue to come down, which is Alex's area, we thank you for that. We're seeing improvement, and we see improvement in the median 5-year inflation numbers. Comes down to 2.8 from 2.9, so not too bad. And then people's household finances, the idea that they're better, 40% to 33% the month before, that's good news as well. And so at this point, it's marginally better, I'd say, overall kind of number than we had seen. I mean, you're seeing people starting to feel better as inflation comes down.
Goldilocks, can we call this number a Goldilocks number? Certainly feels like a Goldilocks number. It's a fairly obvious connection, isn't it, Mike? The consumer sees inflation coming down and feels better. That seems totally logical to me. But as you say, I don't think it changes much. Certainly that would appear to be the bond market reaction right now after a big reaction to the Goolsbee comments a little bit earlier on, particularly on housing. Mike, thank you very much indeed. Let's continue the conversation around this data. Let's bring in Joanne Shu, University of Michigan Surveys of Consumers Director. Joanne, what's the instant analysis? Inflation fades a little bit, the consumer's feeling a little bit better. That feels a little bit logical to me.
I think what consumers are telling us is completely logical. This is a continuation of a huge surge in consumer confidence that started in December. We had a 14% jump in December, and that was followed by another 13% jump in January. So I think what the consumers are telling us is that they truly believe that inflation has turned a corner.